Good afternoon. Welcome to the TheoTRADE afternoon video. I'm Blake Young. Today is December 21st, 2023. Happy winter solstice. It's my favorite day of the year because I know that the days are going to start getting longer. I like the sunlight. I like the warmth. Excited to have the turn of seasons here. So, speaking of that, I was thinking about utilities, heating, energy. And so I want to talk today about whether the correlation between utilities and energy is broken. So I've got on the chart the XLE, the sector ETF for energy, and XLU as a correlation to energy, or sector ETF for energy versus utilities. Normally what we'd assume is that if energy is doing well, the utilities are going to struggle and vice versa. That if energy is growing, it means there's growth and expansion, but it also means energy costs are likely higher and therefore utilities should struggle. If utilities are doing well, oftentimes a sign that we are in a consolidation or maybe a downturn in the economy and market, maybe even a recession. And so a lot of people might look for this to be a highly inverse correlated pair. As we're looking at it, you can see I've got 75 and 75. We're going to squish this down just a little bit so we can see the 100 and negative 100. Anything above 0 is positively correlated. Anything below 0 is negatively correlated. A 1 is a perfect correlation. A negative 1 is an inverse correlation, perfect inverse correlation. And we're generally looking for things negative 50 or below, or 50 and above. That's going to give us a strong enough correlation that it has some mathematical credence. And if we look at utilities versus the energy sector, utility companies versus energy sector, we're going to see the correlation is not that high. And the reason why is because it's a third instrument that is driving utilities and energy. And so there's only a fraction of the correlation that is applied to both and not perfectly inverse. So if energy prices such as crude or natural gas, things that may be used to create electricity, create utilities, are going up higher and higher, then theoretically the energy companies are going to make greater profits. Theoretically. If they're falling, theoretically energy companies are going to make less and utilities should have less cost and therefore they should make more profit. But there's multiple things in here that we need to pay attention to. So right now the correlation is not that great for utilities versus XLE, but if I change this over to crude, you'll see the correlation is a little bit better. Going from 1 to negative 1 is a little bit better, and I normally like to highlight the inverse correlation to show how much time this last year we were inversely correlated to crude. Most of the time, but I'd say maybe only 60% of the time. So is that enough? As we're watching crude prices fall aggressively through here, this would be a good indication that we should see utilities do better, and utilities should be going higher while we're making lower highs, lower lows, lower highs, lower lows. As we've bounced here off the lows, the correlation has remained relatively high, arguably, except for about 5 days going all the way back to October. So 2 months worth of time, about 5 days that we didn't have an inverse correlation in both the downturn of crude and the rise of crude in that same time period. I would argue that's a fairly good correlation. And so as crude prices are falling, it's cheaper to produce energy, or better said electricity or utilities, and transportation costs go down, and that would be good for utilities. But there's an extra component that we may be forgetting. And I could do the same correlation to natural gas, as many of the facilities are now natural gas facilities as far as electricity. And let's go ahead and take a look at that here as well. And you can see the inverse correlation there from 1 to negative 1. We can highlight that. And currently, over the last couple months, we've had that inverse correlation. But much of the year, that's not the case. So my question is not whether that's the case that the inverse correlation is there or not directly, is it breaking? Are we breaking? Is this changing? So as we're watching this inverse correlation all the way down here, it goes beyond the cost of natural gas. It goes beyond the cost of oil. Utility companies in many states have to apply to have rate increases and rate drops. They have to make some adjustments on that to be able to meet government regulation. Some are deregulated, but many markets are regulated by the government. And so natural gas costs can cause correlations to move well, and then they break down like this. So when the prices are falling really quickly, they can't really adjust their prices lower, so the correlation breaks. When we see prices shoot higher, they can't instantly raise rates in utilities, so the correlation breaks. So what is the bigger driving factor of what's going on with utilities? Let me show you what is the bigger driver and something that could be a concern to us in the near future. If I put gold prices in and compare gold to utilities, we need to zoom into the 1 and -1 again because the chart doesn't automatically do that. But if I look at this and say, what is the correlation above the 0 line, and say, is it more closely correlated to inflation than it is natural gas costs? And I would say this move and this correlation is more positively correlated to gold and hedging out inflation than what we've seen in inverse correlation to natural gas and energy. So utilities are going to be impacted more by inflation and overall costs. The problem with that is if inflation is high, utilities are going to go up and they're going to raise and drop rates based off inflation more. They're going to base it off of their own earning potential or margin. If we take a closer look at utilities, taking a look at the last year, utility prices have gone from, or utility companies have gone from the price of $71 all the way down to about $54, then back up. As we're watching the correlation between gold this way, so utilities are up top and the correlation with gold at the bottom, you can see that correlation is still very high and has been for the entire year. So my question is, if utility prices and utility companies' margins are more closely correlated to gold as an inflation hedge, and we don't think that inflation is under control and we're talking about rate cuts, what will happen with inflation? What will happen with costs? What will happen to something core like utilities? What will happen to consumers when they have to spend more of their income on utilities? And therefore, are we setting up for the next bull run in utilities? Not just this 54 to currently about 64, but are we going to see this replicate for another 10-20% move higher, assuming utilities maintain this bullish move and inflation remains high? As we're watching this, we're looking for this move higher. We can see higher highs, higher lows, higher highs, higher lows. You can see that we barely dipped into the oversold area of the monkey bars today. We did break out of the Bollinger Bands, but we dipped into the oversold area while we're maintaining this bullish correlation or this positive correlation with gold. If I throw gold on here just so we can see the gold chart in conjunction with that move, gold prices are somewhere here in the middle, but you can see that gold had a positive day, and if we're moving higher in gold prices, and we might expect gold to continue to moving up back to 2080, 2100, if we're expecting yields to be cut or rates to be cut, gold is likely going to continue moving higher to 2100 or higher, and the correlation that has already been high will continue to be high in utilities. Now, if this correlation is accurate, meaning utilities to inflation, not utilities to crude prices alone, in fact, a better correlation with gold, then we should also see it in yields. So when yields are falling, we should see an inverse correlation to utilities, because when yields are falling and it's cheap to borrow, that means money is free flowing and inflation should be going higher. So if I change this, we go from gold and we change this to 10-year treasury yield. We're going to change this over TNX and hit apply. We should get an inverse correlation. Not only is it an inverse correlation, you can see I'm zooming into 1 and -1 just like I did before, but it's even better correlation as far as inverse correlation than gold is a positive correlation. It's probably 85-90% of the time that we've had an inverse correlation. Those inverse correlations get all the way down to -1. You can see I'm just going to put those numbers in there, -1 and 0, so we get the exact range. And you can see that the most of this year has had a very consistent inverse correlation. In fact, this correlation goes back, and you can see 3 years. This correlation goes back 10 years. This correlation goes back 15 years. This has been a correlation that has been consistently inverse, going all the way back to 2012, 2013, and we did have the time that we had the Great Recession, and coming out of that, there were some real changes, but overall, we've maintained an extremely high inverse correlation between utilities and interest rates. So utilities and interest rates are an actual inverse correlation and very consistent. Currently, from a week-to-week basis, following the long-term portfolio strategies, we're at an 85% inverse correlation, which means if yields are going to drop, utilities should be going higher with an 85% correlation from week to week. If your anticipation is that TNX is going to continue to slide, bond prices are going higher, and TNX is breaking through, breaking out, breaking down out of its overbought area, pushing to the next oversold area, breaking out of the Bollinger Bands and targeting all the way down to 34 or 3.4%, then you should expect utilities to continue to move higher. If we go back to utilities, we know that off the daily basis, we've kind of decoupled, but off the weekly, we're still extremely highly correlated. We had the fake out breakout and a pullback, but again, this seems to be underpriced as we finish this week, oversold, and we could be looking for a bounce and a continuation higher in utilities. And I wouldn't randomly just buy XLU necessarily. Let's take this at an even closer look, and we'll drop this down and take a look at some individuals, starting out with the largest utilities that we have, such as Nextera. Watch for it to pull back here, become oversold, and look for a bounce. We're selling puts down at 58. Southern, SO, and this is all dependent upon the confirmation of falling rates, rising gold, or a bounce out of these oversold areas. Southern is oversold and could give an opportunity to sell puts down here at 69 and a move back up to 71, 72, or even higher. And remember, by selling puts, we don't mind the idea of being assigned on these, because if we do get assigned on Southern or Dominion, getting assigned down at 45 or 46, remember these utilities pay a dividend, and these dividends, like on Dominion, are 5.7% yield. So as interest rates are falling, and we're seeing the expectation that utilities are going to go higher, how would it be to be able to sell puts or just buy the stock when utilities are going to possibly be going higher and the interest rate is going to be sub 3.5%, when you can get a 5.7% out of Dominion? So each one of these set up for a longer time frame, a longer opportunity. Duke had a decent day of recovery off of that low. It wasn't at an oversold area, but something like Duke, again, pays a 4.25%. So going through and finding the best performing utilities or the best place and timing to be getting into these positions, I'm again focusing on the largest ones, and looking for opportunities to collect those higher than normal dividends because they are utilities, can give an opportunity to hedge or risk mitigate if we expect inflation to continue in an area that people will always spend the money, because they will still want to have electricity and heat and power and water in their homes. So go through those and take some time looking at some of the subsets in the utility sector, paying close attention to the fact that we're looking for oversold and bounce up if utilities are going to go higher, and if we see a continuation lower in yields and a continuation higher in inflation. And if we can do that, we can then have the opportunity to chase not a 5 and 6% yield with a high risk, but a 5 to 6% yield on a dividend, nearly 1.5 to 2 times what the bonds will pay, that benefit from the bonds going higher and yields going lower. Well, that's going to do it for me today. Have a great day. We'll look forward to talking to you again next week.